Our planet never ceases to amaze us. The best is always waiting to be discovered. Every corner hides unseen treasures. In unknown places, treasures of breathtaking beauty that leave you spellbound, where you can reach new heights and feel on top of the world. Run your fingers along the relics of a rich past. Discover new places where you can leave your mark. Be the first to witness a land of fascinating journeys. Where in the world could this be? Saudi. Welcome to Arabia. Get your visa now.
Hello, I'm Daniel Franklin, Executive and Diplomatic Editor at The Economist, and welcome to The Economist's webinar on investing for impact and mainstreaming socially responsible finance. This webinar is supported by the Ministry of Finance Saudi Arabia and the G20 Saudi secretariat as part of the International Conferences Programme in connection with the G20 Saudi presidency this year. The overall theme of the G20 Saudi presidency is realizing opportunities of the 21st century for all. Now, we're going to have, during 3 hours of programming in total, 2 panels and 2 keynote interviews. The panels are going to be on socially responsible finance and can it be the solution to the COVID crisis? That's one that I'll be moderating after our first keynote session. And the second panel session is going to be on anchoring the dialogue in the region, so a regional perspective on this whole set of issues. So I think we're in for a fascinating 3 hours ahead. Do feel free to ask questions and make comments, and you'll get, I hope, quick answers from our Economist team. But in the meantime, I'm pleased to hand over to our first keynote session, and I'll see you later at the first panel session. Thank you.
Hello, I'm Patrick Foulis from The Economist magazine, and it's a great pleasure to be here at the Investing for Impact conference. And I'm delighted to welcome His Excellency Khalid Al-Falih, Saudi Arabia's Minister for Investment, who's here to talk both about the Kingdom's approach to investment and how socially responsible principles fit in with that. Minister, welcome and thank you very much for joining us.
Thank you, Patrick, and it's a pleasure to be with you and addressing your audience.
Well, I wondered if I could start with a very broad question, which is how socially responsible investing principles fit in with Saudi Arabia. You obviously have a very big petrochemicals industry, including Saudi Aramco, which you used to chair. You have a very large global investment portfolio through your sovereign wealth funds and central bank reserves. And lastly, you have a big plan to attract investment at home to change the economy domestically. So perhaps you could give us a quick tour of how socially responsible principles apply in those fields.
Well, that is a broad question, and it will take some time to cover, but I will try to be focused and brief. I would just say at the top that if you examine Vision 2030 and look at what it aims to do as well as what it contains, so both in terms of trajectory and destination, as well as the way to get there, it is all about impact investing. It's about responsible investing at the economic sustainability, ecological sustainability, and social sustainability. And of course, in addition to that, at the governance level, as the kingdom continues to improve its ecosystem in terms of transparency and disclosure of its economic enterprises. You mentioned oil and petrochemicals and energy. I'll tell you that the kingdom is as ambitious as anybody in terms of cleaning up the environment, reducing the footprint of our economic activities in general, not just energy, and making sure that we have the most efficient, sustainable energy mix that will be existing in a major economy. And again, I go to the blueprint of Vision 2030. It brings in renewables at a scale that is quite ambitious and bold. His Royal Highness, the Crown Prince, has personally committed to bring hundreds of megawatt hours of solar capacity. In addition, we're building wind farms. In addition, we have announced some of the world's largest programs in green hydrogen. We're bringing electrification of the fleet ultimately to the kingdom, but we're also looking seriously as part of our investment portfolio at electric batteries as part of the solution to reduce carbon emissions. And of course, you look at our water management and our environmental strategy. We're one of the few countries that have the entire chain of environmental stewardship, from having a national strategy to having a national law that was just enacted to put that strategy into practice, to very detailed enforcement and implementation, to even providing incentives, including a specialized fund that is being managed by the Ministry of Environment, Water and Agriculture. The same thing I mentioned in energy, I could speak volumes about what we're doing in water sustainability. The same thing in our sustainable farming strategies that we're rolling on and moving forward. So I think the kingdom is probably the largest laboratory in the world where responsible investing and responsible development is unfolding at a rapid pace and with very high ambitions.
Could I just drill into two things before I think we move on and talk about investment domestically, just because I think the audience will be keen to get your view. One was on Aramco itself and the extent to which socially responsible investing poses a threat. If you look at the super majors like Shell and BP, they're obviously in the middle of a transition away from fossil fuels. How should we think about Aramco in that context?
Well, when it comes to oil and gas, Aramco mirrors the kingdom because they essentially have an exclusive access to the kingdom's resources. The concession is exclusive to Aramco that the government has granted. And therefore, the company strategy is a reflection of the nation's strategy when it comes to sustainability, when it comes to investing, and when it comes to the energy transition that is already underway. I think what differentiates the kingdom and Aramco on the one hand from some of the companies you mentioned is the fact that we have an abundance of resources at our disposal. And those resources are going to be extremely crucial and critical over the next few decades to keep the global development going that has started early in the past century and has powered the global economy through 100 years of fantastic development, bringing billions of people out of poverty, making globalization a reality, fighting poverty and disease and enabling all of that. We don't foresee that coming to a cliff type of decline. But decline it will once it reaches its peaks, which I don't know when, but for sure fossil fuel utilizations will peak, and then starts a slow decline. Some companies will do that transition to those alternative complementary fuels faster than others, and some of it is because they don't have access to the resources I just described. Aramco, I believe, has about 265 billion barrels, which we look at as an obligation to make available to the rest of the world. The other point when it comes to Saudi oil is that it's the cleanest, least environmentally harmful oil you will find anywhere on the planet. The flaring that takes place at Aramco while they're producing oil is second to none. And this has been researched by independent parties and published. Same thing with methane emissions that many oil fields, unfortunately, allowed to emit in the atmosphere, and it has a harmful impact as a greenhouse gas of impact. In both of these cases, the kingdom has next to nothing, or at least we're one of the lowest, if not the lowest. Overall, our carbon intensity as a result of all of this, and the efficiency and the scale with which Aramco operates makes our carbon intensity of producing the hydrocarbons very, very low. In addition, Saudi crudes are light relatively, and therefore take less energy to refine once they make it to markets. So I believe, although we're getting ready to a world where oil intensity will be much lower, I believe every drop of Saudi oil will be in demand as we go forward, and it's a responsibility on us as a nation to put the policy in place and to encourage Aramco to continue to produce it responsibly. But in the meantime, we have to also embrace the energy transition, embrace a lower carbon future, embrace the circular carbon economy, which was adopted as a theme of the Kingdom's G20 presidency in 2020, which includes all of the elements of recycling, reusing, reducing, as we manage energy and carbon in a resource-constrained environment.
So let's turn to the picture domestically, and you're running, I believe, a new ministry that's looking specifically in investment. And could you tell us a bit about the trends over the last few years in terms of inbound investment into Saudi Arabia, foreign direct investment, and also what you see happening this year? I think global cross-border foreign direct investment, so investment by big companies, basically is expected to halve. So tell us what you're seeing from your perch.
Well, I think we have done well in investing in Saudi Arabia, and the result is the competitiveness of many of our sectors in the economy. We spoke at length about oil and gas and petrochemical. That has been the combination of national champions in the kingdom, companies like Saudi Aramco and SABIC and Tasnee and Sibchem and others that have been active. But we've also been able to attract major international multinational companies such as ExxonMobil, Shell, Dow, Total. All of these are major players, and they have chosen to come to Saudi Arabia because they've seen the attractive investment environment in terms of risk returns and the regulatory system. The economy, as you alluded to, has been focused on hydrocarbons, so we have not paid enough attention in the past few decades on growing our productive capacity in other sectors, with the exception perhaps of aluminum and mining. And again, Ma'aden, out of nothing, in about a decade, has become a global player. in both phosphate fertilizers and aluminum, integrated aluminum manufacturing from the mine all the way to rolling mills for aluminum. And they've attracted companies like Mosaic and others to invest, Barrick Gold and Alcoa in the aluminum. So these are global, best-in-class companies in these businesses that have chosen the kingdom over other locations and have done well over the last decade. In the next phase of our development, Patrick, we're going to expand the portfolio of investment opportunities. So value chains will go from primary industries like oil, petrochemicals, aluminum, fertilizers, and so on, into secondary industries and tertiary industries. And we will be moving into advanced manufacturing and advanced materials using nanotechnologies and know-how that new investors have, but also know-how that's developed here through very ambitious research and development programs underway to allow us to use global resources better, including kingdom resources. This will extend the life cycle of materials and reduce their wastage, but it will also add to the sustainability of the planet. We will be moving into areas like tourism, culture, sports, and entertainment as we open these sectors for investment and make the kingdom a more inviting place for visitors, but also a more attractive place for our own people to live and enjoy and prosper and produce and become good global citizens. And we're going to do this with ecology and sustainability first in mind. So eco-tourism is a centerpiece of our tourism strategy. The Red Sea project, for example, which is going to develop maybe 50 islands, 6,000 keys of hotels. It's going to run entirely, and I mean entirely, on renewables. It will have close to 900 megawatts of batteries to allow it to run 24 hours a day on a combination of wind and photovoltaic power generated within the site. It's going to be one of the few sites around the world that is accredited as a dark sky location, where you will not only enjoy the fantastic Red Sea environment with the corals and the islands and the beaches and the crystal clear water, but at night you will be able to view the stars and the galaxies with complete clarity, while preserving energy and preserving the environment and avoiding emissions. NEOM is going to be a zone that is larger than many countries, but it's going to be also running entirely on renewables. It's going to be running with zero wastage of water. It's going to have the most modern and efficient mobility systems that will be very sensitive to protecting the environment. And it will be really defining the future in terms of technologies that also aims to protect our precious planet.
And just a quick point of fact. So since the 2030 project has been launched, have you seen an uptick in investment flows into the kingdom?
Well, I think the performance of Saudi Arabia is mirroring the performance in the rest of the world. FDI has declined since 2015 to 2019 by some 30-40%. And it's declining again according to UNCTAD and OECD. The first half has seen a 50% decline in Saudi Arabia and the world in general. So yes, we are seeing moderate maintenance of our FDI, but my focus and my colleagues' focus in the Kingdom of Saudi Arabia is not on numbers and it's not on dollar figures alone, but it's on the quality and the impact these investments will bring. So Saudi Arabia is capital long. We have been for many, many decades. So we have not been as anxiously looking after FDI as many other countries. Our capital markets, by the way, have enjoyed huge upgrades in terms of their standing globally, in terms of transparency, and all of the global indicators have attested to this, and we've been integrated in the various indices, and as a result, we've seen over the last five years significant inflows of portfolio investing in our Tadawul market, and we will see more as more companies get listed within our capital markets, and as the ones who are currently listed who will undertake more work probably go to the market and raise additional funds. So I think the future is where I'm focused. We're going to be drawing on quality and on capital from sources within the kingdom, and there are plenty of them, both private and public, as well as our partners around the world.
One of the big difficulties with sustainable investment is both setting up a system to measure the results. That's one. And the other is connected, but changing incentives in terms of the people running projects, the people allocating capital. How are you measuring the social impact of investment flows and projects overall? And what are you doing to change incentives so that behavior changes as well?
Well, I can tell you, Patrick, that within the Saudi government today, we don't speak three sentences without mentioning the word KPI. Everything is being measured from a performance in general, but that performance is cascaded down to the various categories, including environmental sustainability, including social responsibility, including economic viability of every Saudi riyal we allocate and every Saudi riyal we invest. And we have detailed tools that allow us to monitor and measure and manage and feedback into our plans and adjust to ensure those KPIs give us the optimum results. So in terms of environment and sustainability, we are looking at everything from coral reefs are measured constantly, mangroves, green cover on our soil, onshore. I mentioned our strategy for the environment. We have a plan in the next few years to plant 10 million trees within the kingdom and 3 million mangrove seedlings on the shoreline. Imagine the amount of carbon uptake they will take, offsetting the consumption that not only takes place in Saudi Arabia, but around the world. The Red Sea project will actually increase corals within its territory, as well as has already applied to prevent fishing, to restore fish stock within the northern Red Sea environment. So these are some of the KPIs that are cascaded down to the project and to the entity level, but they all get aggregated. On the social side, women participation is being measured month to month, and the slope is like this. Ultimately, the aim is to have both genders participating equally across society, across the business community, and across government. And that's not a day far into the future, just measuring by how much we have done in the last 2 to 3 years, empowering the youth, where 70% of our population is young, and we see it as our number one obligation to make sure they are empowered with opportunities as entrepreneurs, as leaders, as scientists, technologists, engineers, doctors. So our entire system of education, our healthcare system measures life expectancy and all of the type of measures on morbidity and mortality, and that's part of social investing. We're trying to improve the quality of life for people, for citizens of Saudi Arabia, but equally for the residents who choose to make Saudi Arabia their home.
Minister, I think we're almost out of time, but I wondered if I could ask for a quick response. Which other countries have you looked at, and which countries do you think are getting this right? You must have compared the kingdom to lots of other places.
Well, first of all, let me say that there is no perfect country, and I think we find I mentioned KPIs as being a constant in our discussions here, but so is benchmarking. So we do a lot of benchmarking. I think in education, some of the Scandinavian countries have done well. So the last topic I talked about of improving our human resource systems, we've looked at Scandinavian countries. In the area of investing, we've looked at Korea and Singapore, and we see them also in logistics. Singapore has been good, and the kingdom will become a global logistic hub. In technology and innovation, the U.S. has been the global innovator of most significance. China is gaining there, and we have close relationship in China. And you will find within different areas in Saudi Arabia an attempt not to replicate, not to copy, but to adapt these best practices and add to them and create centers of excellence in Saudi Arabia that others will be looking to replicate in their own countries, I hope, in the future.
Minister, we're exactly out of time. Thank you so much for sharing your thoughts on that and the ambitious agenda you've got over the next decade in Saudi. It's been a pleasure to have you, and thank you to the audience very much also.
Hello, and welcome to this panel on Can Socially Responsible Finance Be the Solution to the COVID Crisis? I'm Daniel Franklin, Executive and Diplomatic Editor at The Economist, and I'm joined by Amit Bouri, Chief Executive and Founder of the Global Impact Investing Network, Joniel Hachem, Chief Executive of Edmund de Rothschild Private Equity, and Sonia Weymuller, Founding Partner of Venture Souk. Hello, and welcome to all of you. I think we have an extremely important and highly topical subject here, made more topical by the problems that have arisen under COVID, really in two areas above all. I think the problems of inequality that have become even more acute because of COVID and become more glaring, and the issue of the crisis beyond this one, if you like, the climate crisis, where impact investing has long been seen as perhaps part of the solution. But what we want to explore here is how much of the solution, how to make sure that this is really serious stuff and not mere talk, and how do you do it in a way that actually is most effective and can make the biggest impact. So that's the broad subject matter for us. And I'd like to begin with you, if I may, Amit. Your network is a huge one. It's very well known. But tell us really what the point of socially responsible finance, of impact investing is, and how it's grown in recent times. How do you see the trends? And what about COVID? Is it really part of the solution, not to the disease itself, obviously, but to the issues that are being brought to the fore by COVID?
Well, thank you. And first, I do just want to say that I'm very grateful for the opportunity to speak, with this wonderful group about such an important topic. To your first question about what is the point of socially responsible investing, I think the point has actually been evolving with time. Fundamentally, this is a question about what is the purpose of money beyond just generating more money, and people have evolved in their thinking about what that potential is. It started with a focus on avoiding harmful activities, so divestment or negative screening, getting bad things out of your portfolio. And then there's been an evolution towards thinking about how you can use environmental, social, and governance factors to incorporate into investing more broadly, commonly known as ESG. And that has been really surging into the mainstream, largely motivated by interest in using ESG factors to mitigate risk. So what environmental factors can pose risk to the performance of your portfolio? Where impact investing fits in is actually complementary to those other efforts, but is really about how do you put money to work to have a positive impact on any number of issues. Provision of basic services like housing, health, sustainable agriculture, mitigating climate change, and overall contributing to the Sustainable Development Goals set out by the United Nations.
Let me just ask you specifically about COVID, because it has amplified inequities. What are you seeing that impact on impact investing?
Yes. So I think the COVID crisis is clearly compounding many inequities that already exist in our society. And these are inequities driven by socioeconomic status, by gender, and also by race and ethnicity. And one of the things that has been so powerful about this crisis is that it is really forcing people to look at the world around them, see it in a different light, and understanding that if we want a world that is truly sustainable, inclusive, and just, we have to change the way that we invest. What we've been observing, even in the past few months, is an acceleration of a trend that was already underway. Many more mainstream investors are moving towards impact investing, predating the crisis. But I think that is because many of the world's larger institutions, if we do want stable economies that are sustainable, we have to make sure we address inequity and the climate crisis in a much more fundamental way. So I think this is an important moment where impact investing and impact thinking becomes front and center for a much broader set of investors.
Okay, and I believe you have a specific initiative which has 3 R's in its name. Tell us about that.
Sure. So as the pandemic was really unfolding, we partnered with a number of foundations and other impact investing networks, 12 in total, the GIN being one of them, to launch what we call the R3 Investment Coalition. And those 3 R's are for response, recovery, and resilience. Recognizing that we didn't want to just focus on the immediate response of the crisis, as important as that is, but also to drive more impact investment through the recovery and ultimately towards a more resilient system on the other side of this crisis. And so those 3 R's are really shaping the way that we're thinking about how we respond to the moment that we're in, but do so in a way that is building towards a better system as we emerge from the crisis.
Well, we can all agree that sounds great, but I'm not going to let you get away with it entirely at face value. We're going to be probing and digging into this and where the pitfalls may lie. But let me first turn to Johnny El Hachem for your take on the broad purpose, if you like, of this style of investing, because a lot of it is really about doing things that are going to work in the long term and not just short-term returns, isn't it?
Yeah, absolutely. The problem is that we've been always, from an investor's point of view, thinking about short-term return without taking into account what is really needed to be in a resilient world. And that's the real problem. The real problem lies in the fact that the financiers ourselves, and we have a huge responsibility in that, we've never saw that finance has to be a conduit, has to be a tool, has to be at the service of the industry. And this short-term return led us where we are today. And everything is linked. We are in a circular situation. Amit spoke about inequalities, spoke about, and he didn't mention it, but it's a reality. Populism is all over the place. And he spoke about response, recovery, and resilience. how to reach resilience, the real problem is that governments, through response, the only thing put more debt in the system. This is not the solution. And now we live still in the second wave in Europe when it comes to the COVID, and the response made by government has created a lot of uncertainties and lack of visibility about what would be the real consequences. Today, because of the huge amount of the debt on the system, the response made by the governments led the banks step back and don't really trigger governance and trigger what would be the real world afterwards. So this is the right moment to have a collective response, but a responsible one, to reach resiliency. How? It's very simple and it's very easy to do. It's a matter of doing it. To achieve it, all the stakeholder has to put in mind that first, and if you remember in New York in the Economist event about sustainability 2 years ago, with you, Daniel, we said that the sustainable investment or impact investment, name it as you like, should not be the niche, should not be the alternative. The rest are the niche and the alternative. That's the real path to reach resiliency. And we need this resiliency to build a better world. So it has to be, finance has to be a tool for long-term return. We should act in a way to stop this short-term thinking, increasing leverage. And by the way, to answer properly your first question you addressed to Amit, what are the consequences and what COVID did shed the light on in the world we live? You see the lack of investment in health infrastructure. This is where real impact should go, and we should consider the fact that we need to invest in the health infrastructure. Tech is all over the place. Tech is not a disruptor. Tech will not kill businesses. Technology is a way to reinforce the impact and to reinforce, to enable businesses to evolve. And add to that, we will not deep dive into the need for remote working, and we've seen this, you know it now. Add to that the fact that the real estate sector, the way it was designed, it was a disaster. We wanted short-term return. City expansion was made in a way not to take into account soft mobility. We've threatened our own food security by sacrificing the arable land, by doing this large city expansion, where we've ended up living in a world which is congested. We didn't take into account what is the common sense on how to do and deal with things. Now it's the right moment to be impactful on that.
Can I just say, this all sounds great, and I wouldn't argue with any of it, but I want to question whether the impact of COVID has really made investors want to be more interested in the long term than the short term. Because right now, what one sees, where the money is flowing overall into the economy is very short term. It's emergency, it's life support often for the economy. So are you really seeing your investors, for example, saying, okay, we have to be longer term? Is that really happening?
Yes, absolutely, Christian. It's that, Daniel, sorry. Yes, absolutely. It's happening. It's happening for the simple reason, and this is helping us as well. Because of the current market situation, the high volatility, it has been proven all over the place. Impact investment lowers volatility in the portfolio. The fact that you lower volatility in the portfolio, today, the investors understood that there is a premium for illiquidity, but this premium for liquidity, they are ready to pay, to benefit from it by being engaged on the long term. They've understood it. And by the way, before the crisis, we private equity managers had the record high. We've never reached such a level of dry powder to be deployed. Now, what COVID helped us to demonstrate to our investors, to our funders, to the asset owners, it helped us showing them that assets which really proved resiliency has the best return and maintains a high level of valorization or prices. And this is the right sign to prove to the investment community that, guys, if you reach this level of resiliency thanks to the impact and to the measures taken on evidence-based way to achieve this impact and manage it, it's a way not only to build a better world, but to generate better returns. And it has been proven. And the problem is, and we should be in a better situation now. In the beginning, investors used to associate or link impact investments and philanthropy and foundations. Today, we can prove through real examples that we don't sacrifice return to generate impact. We manage impact to reduce volatility in the portfolio and secure return.
I think that's very interesting. So you're saying that there's a sort of double enlightened self-interest. One is that there's the good of society, and the other is it's actually good financially. It makes financial sense as well to do this. So we'll come on in a minute to why then it isn't self-evident that this just happens because it's in everybody's interest. But I'd like to turn first to you, Sonia Weymuller, and your experience with Venture Soup, because I think you have relatively recently launched an impact fund. Your fund started some years back, but the venture part of it, the impact part of it, started relatively recently. And you also take which is I think very striking, a regional approach in the Gulf region. So perhaps start by telling us about those two perspectives: the fact that there's new interest in the impact side of things in the Gulf, and why this regional perspective rather than the regional approach rather than just a Dubai or UAE one.
Right. So Venture Souk as a whole has been around since 2013. We're an investment platform that invests in early stage tech-enabled businesses globally. And more recently this year in March, nothing to do with COVID, it just happened, it was pure synchronicity that we happened to launch around the same time as COVID. We launched our impact arm, which is called the Venture Souk Conscious Collective. It's actually the first regional kind of fund, if you will, coming out of this region. The venture capital landscape here where I sit is pretty nascent. You add the impact layer to it, it takes it to a whole other level of confusion. And so it was really important to me that we first focus on educating the market. In fact, I don't even use the word impact investing because it comes with so many different connotations. So we talk about conscious investing to capture kind of the intentionality of it. And we launched in March. We focus on several sectors, so ed tech, ag tech, environmental tech, financial inclusion, and health tech. We have a global remit. What I found was that there was a lot of interest that was just not tapped into yet. So it was kind of inbound interest from the network of investors that we have, who came to me saying, I have an interest. I want to start investing in things that I feel are more meaningful to me. I agree with what the gentleman said earlier. COVID has accelerated that conscious thinking. How do we give our money more purpose? How do we give our money more power? How do we give our money more impact? And so I think this also is reflected here in the MENA region as well. But investors just didn't have an outlet to kind of invest into. So that was the purpose of us setting up the vehicle. It's basically the first kind of regional vehicle that brings together individual investors and family offices who are aligned in their thinking and their motives and their purpose. In conjunction, kind of in line with the educational angle, it would have been very silly of me, to be perfectly blunt, to say, let me just launch a $100 million fund out of MENA because we know that there's deep pockets in this region, right? No, it doesn't work that way because people would have just looked at me blankly being like, what do you mean by impact investing? Oh, no, that's philanthropy. It's very two-pocket thinking driven here still, right? So very deep pockets, very deep pools of capital, but one pocket for philanthropy, one pocket for-profit kind of traditional investments. So it's very important for us to educate the market for them to understand, no, it doesn't have to be the case. And in fact, with the deals that we've looked at and invested into so far, we're looking at deals exactly the same way that Venture Souk typically looks at deals commercially. So we have a portfolio, as I said, of 160 companies globally now. However, we're focused on sectors that we feel are still underserved from a capital injection standpoint. And that's back to the sectors that I mentioned earlier. And so we basically launched a Conscious Investor Fellowship 4 weeks ago. So we're literally in the middle of it. It's a 6-week fellowship. And we were meant to invite 25 investors. We ended up with 32 and a wait list. So again, a testament to the fact that there is an appetite for this here in this region. The backgrounds are very mixed. So we have kind of high net worth individuals, but we also have family office reps. We have corporates, we have government entities who are represented. We have 57% female investors, which I'm very proud to say when you think about, kind of the venture capital industry in the US, which is 12% female. And that's very important. That diversity and inclusion bit, as Amit mentioned earlier, is very important because whoever is investing, it needs to be a reflective of our society as a whole, right? In order for us to kind of make empathetic investment decisions as well. And so we basically take them through everything from, what is conscious investing? How does it fit within my overall conscious investment strategy? How should I look at deals? How should I diligence deals? How do I value a company? So we go through the valuation kind of module. What should I be aware of in term sheets? Again, we're very much focused on tech-enabled, mission-driven companies because we believe that is what is scalable, as Johnny said earlier. How does technology act as a multiplier for good? And I guess my take on it is that venture capital should act as a magnifier of good as well, right? And that's the purpose. And so really, I hope that by the end of this fellowship, we would have created this shift in mindset. And we still have some really hardcore fellows who are still like, oh, do you look at deals? Do you need to be softer when you look at mission-driven companies? Like, do you need to be softer in the questions that you ask them or the type of diligence that you do? And the whole purpose is saying, no, we want to invest in companies that are going to do well, but have a positive outcome at the same time. So you're not going to be concessionary with regards to your returns necessarily. In fact, you should not be concessionary with your returns. And you want to invest in the next company that's, I'm not going to use the word unicorn because I feel like it's overused, but a company that's actually going to have meaningful, scalable, positive outcome, whether it be societal, whether it be environmental, or around financial inclusion.
So it's fascinating, and the fellowship sounds like a fantastic initiative. But to give a sense of how that works, how long does this? Essentially, it's a sort of training education program you're running. How long does that last? And would there be other is this a rolling program so that when your first set of fellows graduate, you will have the next lot?
Yeah. So two things. One is for me, it's very important that this be kind of a long-term fellowship. So this is the first cohort. The fact that we have a wait list means that we're going to do it again. Secondly, it was very important that this not be just a UAE-based fellowship. For those familiar with the region, there's quite a bit of chest thumping over here. So I am Dubai, I am Abu Dhabi, I am Saudi, I am Bahrain, I am Kuwait, etc. So I really wanted to bring the different players from across the region together, which is why we partnered with NYU Abu Dhabi, Start AD at NYU Abu Dhabi specifically, Kaust in Saudi, Shara in Sharjah, Hub 71 in Abu Dhabi. Hopefully next year we'll have a Bahrain entity, a Kuwaiti entity, an Omani entity, so that this grows in terms of the partnerships that are struck. From a cohort standpoint, also very diverse. I mentioned the gender ratio earlier, but the bulk of the fellows are based between Saudi and the UAE. We have one fellow from Bahrain, one fellow from Egypt, and one fellow who sits in Geneva, actually, who has an interest in this region. And so, yes, this is, for me at least, very much meant to be a grassroots kind of endeavor that grows into its own. And, the caliber of the cohort, these are all senior level executives. These are not kind of analysts necessarily at the firms. We have some kind of juniors as well, because again, I wanted to capture the diversity. But the fact that we have such senior level executives involved and who actually accepted to do the program, it's 6 weeks. And so, everyone's super busy, but if you can carve out 2-3 hours of your week in order to do this, that means that you're actually interested in this space. So they had their first assignment due last week, which was around articulating your theory of change. What was interesting about that was that the feedback was amazing, because I think we all lead busy lives. No one really takes the time to sit. Yes, we want to have an impact and we want to have scalable impact. What does that mean in practice? And so for them, the assignment forced them to actually sit with themselves for 2 hours. And the way we built out the assignment was some level of hand-holding to kind of run them through the idea of how do you articulate your theory of change and what that means in practice. Now, the second assignment is that we gave them yesterday around impact measurement and management. So Amit would appreciate that. That was a module that was led by Kareem Harji, who I'm sure Amit knows as well. And now basically we've given them a case study one of our portfolio companies from Conscious Collective, actually, and they have to go in and use Iris Plus and go through some of the metrics, identify the ones that are relevant, and actually will go through that exercise on their own.
So I think you've given us a very good segue to what I wanted to go in, which is actually what I realize is here we need to do this fellowship, which you say lasts 6 weeks, but we've got about half an hour now to cover all the coursework in this session. And I think the fascinating thing is you mentioned measurement. There's clearly, from what all of you have been saying, there's a lot of very good reasons to be prioritizing this. There's reasons for society, but there's reasons for returns as well. But I think then a lot of people, when they come to it, feel confused. Well, what counts? What qualifies as impact? Is it anybody can put a badge on it and say, well, this has impact because of various reasons that may or may not be convincing. You mentioned Iris. I think, Amit, it would be interesting for you to talk about this. What about the stage of getting common standards, of common agreement of what socially responsible investing is and how you measure the results? Because if I'm an investor, I want to know, is my money really going into this sector, or is it just going under the badge of it, but really indistinguishable from everything else? Do you want to talk to that, Amit?
Yes, absolutely. And we talked a little bit earlier about how we see mainstream investment moving into impact investing, which is such an exciting development. But the GIN strategy is really focused on scale with integrity. So we need to move a lot more capital to have a positive impact, to address all the issues we're talking about, to achieve the Sustainable Development Goals. But we need to make sure that that capital has integrity of impact. So it's not just labeling or badging or promising or pledging, but it's about driving real results for people on the planet. Now, what the Iris Plus system, and it's IRIS with a plus sign, it's free, it's online, it's very accessible. But the idea is that we have developed a system that allows investors to translate their impact intentions into real impact results. We've worked with partners all around the world, and you can start with a theme like gender equity or a sustainable development goal like affordable and clean energy. Identify the investment strategies that you can use to contribute to that goal, and then get to the specific metrics that you can use to track at a business or investment level. Now, these metrics are all backed up by evidence. We work with a mix of investors, businesses, and experts who bring that technical expertise. And the idea is really to get the same language when it comes to impact. Right? So we don't have investors who may be very strong at building up companies, trying to become experts in climate mitigation and gender equity and sustainable agriculture all at the same time and inventing their own way of measuring things. It's highly inefficient, probably not going to be that effective at a systemic level. So one of the roles of the GIN as a nonprofit is to build the infrastructure that lets the market grow in its scale and become effective. And so Iris Plus is a way to do that.
So it ties these back to the Sustainable Development Goals, doesn't it? So you can track against progress in those, in those goals. Is there competition in place? I mean, you have this one way of measuring it, but other people may have another way of measuring it. So is the world coming together or converging slowly on common measurements?
I think it is, but it is a bit messy now. But I'll explain kind of what we have all different ways of measuring things, and we have over 150 different partners who have metrics, tools, frameworks, principles, et cetera, that are all trying to drive towards greater integrity of the market. One thing I should mention that with Iris Plus is that we work with over 50 different standard setters and platforms who are all, some of them are doing macro level measurement and some of them are deeply specialized in a specific sector. But the idea is to integrate the best measures that we find. We sometimes have to fill gaps, and we work with partners to do that. But so investors can find those metrics that make sense for them to really drive towards positive impact. And that's what we try to do in the system. And so far, it has over 11,000 users all over the world. It's been out on the market about 18 months, but it builds on a decade of experience that we have and plenty of great folks, including those that Sonia and others have mentioned.
Johnny, what about your experience with measurements? What do you use, actually? I mean, you're not tied into anyone in particular. You can survey the landscape. What do you use and where are the gaps from where you sit?
So as far as we are concerned, We've been in this field for almost 2 decades now, and we invest in Europe, in Africa, and in the US, and we cover the whole spectrum. We have a fairly large amount of asset under management within the different strategies. We have 13 strategies deployed by 11. For that, we don't have a single methodology for measurement as for the diversity of the thing that we cover, from soil remediation to agroforestry, investing in SMEs in Africa, the bootstrap technologies companies that we do in Europe. So the diversity of the thing we do pushed us to, and the absence of common standards pushed us to define our own proprietary methodology for each of the strategies we work on. The second thing we've been working on as well, in the beginning, it was, as Amit mentioned, we were in a world where the simplest thing to do was exclusion. We went into more intentionality by saying simply, let's put finance at the service of the industry. Let's identify bottleneck situations for which we can use finance as a tool and the industrial expertise to find solution. Unfortunately, I can't explain what we do in the soil remediation field, agroforestry, or investing in SMEs for the benefit of immigration or for the benefit of the climate. But what I'm trying to illustrate here is the diversity of this thing that we cover from with the intentionality pushed us to develop our own metrics for measurement. Now, this was the second thing we've done. The third thing we're doing right now, what we are afraid from, is the fact that this large capital coming and this large interest coming to the impact space, we end up being in impact washing as we were in greenwashing a few years ago. So how to be genuine about it, it's very simple for us. And we started implementing it now with our third vintage of our soil remediation fund. What we're doing is very basics. You can't be a long-term investor and being paid in terms of performance by measuring the IRR, which is time value. It doesn't make sense. So we managed to convince our large investors now to design the performance fee based on IRR from one side, definitely, but as well on specific metrics to be measured and to deliver the incentive, call it carried interest or whatever, that the managers will get based on the tools that we predefine. A third party, like any auditor who measures the carried interest normally or the IRR, will intervene to measure those impact if achieved, and then we're going to be paid. And I strongly believe this is the right path to be taken. First, to be genuine with the fact that this is a long-term approach and not a short-term approach the way we've been dealing with private equity in the past. And second, it really shows who are the real managers, really ready to find real solutions to the issue and being motivated and incentivized accordingly.
So, Sonia, to pick that point, is this an approach that works in the stage of investing that you're involved in? Because you're really typically, I think, earlier stage investing. So is that going to work for early stage investment?
Well, so I guess a few things on what Johnny said. I mean, I hope one day that some of our portfolio companies end up on Johnny's desk down the line. We focus, inshallah. We focus on seed all the way up to Series A. So we've done 3 Series A's, 1 pre-Series A, the rest have been seed. So I echo what Johnny says about the standardization bit. I mean, obviously for us, it's very important that we have some level of kind of internationally recognized framework in place, which is why we use GINs. In addition to that, we use our own, so we layer onto it. There is no one size fits all anyway per sector, per industry. So you're not going to look at a deal in the ag tech sector like you will at one in the health tech sector necessarily. So that's one thing that needs to be very clear. The other thing that I agree with all that we're saying, which is that, investors are increasingly looking to impact metrics moving forward. Even more traditional VCs in my space, the Andreessens, et cetera, are starting to incorporate now impact measurement for their own portfolio companies. So that's already a sign, right? What I find interesting, and I'm not sure if it's the same in your markets, but at least in the MENA region, I find that the entrepreneurs are extremely ill-equipped when it comes to this. And so I guess part of my job when I sit down with at least regional entrepreneurs, we have a global remit, but we're also kind of hoping to find one or two gems here in the region that we sit in, is that they don't really know how to articulate their theory of change. I mean, they know what they're doing it for a purpose, etc. It's just not under a theory of change kind of official, awning, if you will. But even when it comes to impact metrics, they're not kind of sophisticated when it comes to even thinking about it, because all they think matters to investors is the commercial KPIs. And so, at least for my sake here in the MENA region, I think there's a huge gap when it comes to actually educating entrepreneurs around impact metrics as well. Yeah. I would say on the investor side, I think we're a little behind to where Amit is sitting probably. I don't think we're seeing any of the regional VCs really. Yes, they'll probably look at SDGs because everyone uses SDGs and throws it left, right, and center without really understanding what it stands for. I feel like it's almost become a checklist. Oh yes, we have 10 SDGs covered out of the 17. What does that mean? Okay, is this just a checklist to kind of make your LPs happy? So I think that. I hope at least that when some of the other regional VC players look at the work that we're doing with Conscious Collective, that they start reflecting on their own kind of impact measurement capabilities for their own portfolio, because I really want, and I wish, and I hope it happens in my lifetime, that we stop disassociating kind of traditional investing with impact investing, which is why I don't like to use the word impact investing, because it's investing. Let's just call it investing, period. This is what, and this I hope is where we're heading.
It should be just the mainstream.
We should call the traditional investment the negative investment, and this is
maybe that's what we need.
and just if you allow me, Daniel, a second to react to Sonia's comment. Through our MENA fund, we have a fund investing in SMEs in the MENA region. You can't imagine, especially in the family businesses, at the level of the principals and the owners of the business with the second generation, the need for them to make sure that at the level of their business, through the growth plan, they can achieve an impact path. So what we've done as well, and that's something we can elaborate on if you'd like what point in time, Sonia. Now, when we do our SPA and when we do our shareholder agreement, there is specific covenants related to the impact that we need to enhance in a business. Definitely not to act in an exclusion way. It doesn't make sense. The best thing to do is to transform a business which is not good into something better. And then those metrics are part of our shareholder agreement with covenant links that allow us to trigger real events in terms of dilution or whatever if those metrics are not met through the day-to-day management. And this is something valuable by the shareholder, the sponsors that we invest with, or the family, because this is a way, and I agree with you, some the managers or the second man in a firm didn't integrate yet the importance of those elements. The moment which can create a covenant or a negative event, then they will start integrating it properly in the day-to-day.
So I want to get a sense in the time that we have left of some of the really big question marks over this and the possible solutions to them. So first question, and perhaps Amit, you take this first. Is the problem that there is not enough money to tackle the investments needed, or not enough projects to put the wall of capital that is waiting to go in? Which is the problem?
It depends on who you ask. If you're asking the allocators, sometimes they'll say that there's not enough deals. If you ask the businesses or the entrepreneurs, they'll say that we need more investors. Fundamentally, though, I don't think it's a one answer fits all. I think that because we're looking at different sectors, different parts of the world, so some things are more saturated and others are starved for capital. But what I do think, and that's just part of any functioning market, right? Things are not always in lockstep in terms of supply and demand. But what I do think is important is that there is a virtuous cycle here, right? As entrepreneurs realize that there's more capital available for them to back them with a mission-driven or impact-focused business, that will get a lot more entrepreneurs seeing the opportunity to build wonderful businesses that are really focused on impact. And similarly, as there are more great examples of companies going to scale and portfolios succeeding, we'll see more and more investors allocate capital. What I do think is important, though, is that now we are seeing this shift that we talked about earlier, that I think we're just seeing the leading indicators right now. We're obviously still, unfortunately, in the midst of this crisis. It is still very much far from being contained globally, but it is driving a lot more investors to be thinking about, how do I think about kind of the impact of my portfolio? What's the role that my investments are what's the role that my investments have in shaping the world that we live in now and for the future? And the important part is that there is an approach and interest in this being disciplined. And that's where all this discussion of measurement is so important. The CIO of an institutional investor now, they are interested in impact measurement. It's not just the do-gooder folks or the philanthropists or the governments. It is actually like investors want that data and want to understand how they can drive greater impact performance. And I think that's a very powerful opportunity.
And so to pick that up on what the data actually tells you right now, I'm interested in all of your thoughts on where the biggest returns coming out of COVID in terms of impact are likely to be had. What are the sectors? What are the areas where socially responsible investing is going to make the largest impact over time, going to have the largest returns? Where is the greatest amount of interest from investors starting to focus on? And Johnny, perhaps you could have a first go at that one.
And I'm happy that you came with this question right after the one you addressed to Amit, because they are extremely linked. Today, yes, there is a lot of money. The problem is that this money available, and allow me to use this term without offending anyone, is the lazy money. What do I mean by lazy money? This excess of cash. Because government, when there is an issue, the only response they have, we fuel the system with more debt. Who will pay this debt one day? That's another debate. Nevertheless, this excess of cash available in the system, the investors tend to look for short-term return and tend to not to take the real risk. So no one is taking the real risk. The problem is, we can argue hours about scalability and replicability, but the real problem is the bankability of the projects. I'm so happy that actors like Sonia exist, because they will help us reach the level where lazy money invest in more mature companies, and she's taking the real risk. And now to answer your question about where we see fantastic opportunity, definitely in infrastructure. Why? Look at the lack of hospitals. Look at the lack of issues in the health segment globally. I'm not speaking about one single region. Why? Because this used to be the responsibility of the public sector. Public sector, with the level of debt they have, they can't do it anymore. And the private sector has to take the risk and invest in greenfield opportunity. And this is where we can shape and do the largest impact. So definitely in the infrastructure, socially, at the level of the health sector, redefining cities, and this is infrastructure, urban sprawl, urban regeneration, redevelopment. There is areas where there will be fantastic return and you can shape impact. Add to that, look at the problems we faced in the beginning of the first confinement in Europe, when all the communication networks were saturated. In the telco, in the infrastructure telecom, there is a huge need and demand, and that's a way as well for less inequalities. The problem is that the more you develop cities, less you take care of the rural areas, the more end up having more inequalities, more populism. And you know the story all over the place, it's the same. So in the infrastructure field, provided that we as investors take the greenfield risk, the construction risk, and join forces with the industrial world to build a more circular economy when it comes to the industrial world, how to build the real plant that help us recycle the waste and reuse it as an entrant to secure the supply and reduce dependency to secure supply on Asia or on importing raw material from elsewhere, rather than recycling what we produce. These are fantastic areas where if you take the right risk with the right know-how, there will be fantastic return. Add to that the fact that we need young and talented people to coming to the aging continent or to the places in the world where we need young population. Rather than getting immigration as a consequence of climatic situation, rather than getting immigration as a consequence of social issues, It's our responsibility and duty to benefit from the fact what MENA region offers as young and talented population, as Africa offers as young and talented population. Let's invest in businesses there. Let them grow from local players to regional players. Then by creating a good welfare in these economies, we can select the best talents and the one who wants to join the aging population to solve the real problems of debt that we ended up being in because we didn't build a resilient world. And that's the purpose of real investing.
So Sonia, picking up on that, and Johnny said that you are at the risk-taking end of things. I'm interested to know that on the impact end of it, one often thinks of the venture world as very heavily tech focused these days. Is that still the case, or with a lot of the investments that Johnny was talking about were sort of traditional ones in hospitals, in infrastructure of various sorts, including technology, but way beyond it? Where do you see the mix of the type of industries that the early end investment will be going into for impact?
Obviously, you'll hear about ed tech, and you'll hear about health tech, and you'll hear about financial inclusion, so fintech. So I think those are the ones that you usually hear about. But actually, the latest investment that we're closing right now is in the supply chain transparency kind of realm. And I think that that's something that we're going to see at the forefront now, because as we discussed, I think earlier, corporates are no longer benchmarked solely on their financial track record, right? So shareholders and the next generation of consumers are increasingly holding them accountable. And I don't start talking names, but recently, 2 weeks ago, one specific corporate was in the news because of this, when they had kind of a shareholder rebellion with regards to their kind of deforestation and lack of transparency around the impact that they were having on forests for some of their products. So I do think we'll be seeing a lot more stories around supply chain accountability and transparency, because I think some companies need to understand that they need to make strides when it comes to becoming more transparent and sustainable with regards to how they operate across the value chain and what they choose to disclose or choose not to disclose. I think that's kind of an area that we have our eye on, if you will. And I think it comes back to what we were talking about earlier around intentionality. So, the sentiment is not just around the do no harm, but the expectation is actually around companies having to think about how they can consciously and intentionally create positive social impact through their operations as well. And so this is only the beginning. I think you'll see a lot more corporates in the news in the coming months and in the coming years, being held accountable by their shareholders, but also being held accountable by their consumers. And not to say that I'm old, because I think I'm on kind of the older kind of level of millennial. But when I look at my analysts, for example, who are, I guess, a generation younger, kind of, it's very apparent to me, they're very picky on the brands that they choose to buy. They're very picky on the investments that they choose to make. So it's only a matter of time where we're going to see kind of that turning point, if you will, where everyone, this is really the future of investing. Whether you like it or not, this is the future of investing.
Yeah, you're describing the pressure pushing in all this, which is the consumer end of the pressure. Johnny, if you could wait just a minute, because we're running out of time. You come into this at the end, because I'm going to ask you, each of you, in a final round, just for 1 minute each, because that's all the time we're going to have. If you could put your finger on one thing that you think would have to happen to make this whole field of investment really start to fulfill its potential. What are the missing links that you would like to see fill in? Sonia, why don't you go first?
Education. I mean, at least where I sit, but I suspect it's probably the same in Europe, in the US even. Dispelling this myth that if you're investing in a company that has a positive outcome, that you're not going to see your money back. There are tons of socially conscious entrepreneurs who are doing amazing things in this world, whether it be in Africa, whether it be in India, whether it be in Southeast Asia or the West. And they are doing it in a totally financially sustainable way and doing it very consciously and with intentionality, but also understanding that in order for them to have the most amount of impact, the business needs to work as well. And so I think we, at least here as Venture Souk, it is our job to educate the regional investors here, whether it be the corporates, whether it be the government entities, whether it be the family offices or the individual investors, that these opportunities do exist. And so my hope, for example, with Conscious Collective is we would have made probably like 12 or 13 investments by the end of the year. Here are some case studies. Here are some examples. These are not companies that are looking for handouts from philanthropic organization or CSR budgets. These are companies that have a sustainable business model that works.
Thank you, Amit. How about your perspective?
Yeah, just to build on what Sonia said, I thought that was a great answer, and I think what I would say is that we are really recognizing a shift towards the future of investing, where impact becomes part of. So, given investor or business leaders looking at their positive and negative impacts, and just a much more holistic vision and version of what performance looks like, what success looks like, and what drives value. But one of the big things that we're focused on together is to develop the methodology on how we can understand and benchmark impact performance. It's not just how you measure impact, but how do you actually understand whether or not you are performing well when it comes to things like mitigating climate change, addressing gender inequities, trying to drive more sustainable forms of agriculture and land use. We just piloted 2 studies in agriculture, and we're building the methodology to really help people think about how they can understand ultimately how we can drive when it comes to impact performance. So it's a dimension of performance that we have investors competing on how to do the best job at achieving an impact for people and the planet at this time when the world really needs it.
And I'm sure you're working on that, refining that right now. Johnny, your final take on the missing pieces.
Yeah, for me, the missing pieces is the following. How to be in a situation to meet what large investors require. Today, large investors, the big ones who can shape the world, would like to deploy large tickets because they have much more money on hand. The problem is with the scalability. One would argue, what you're doing is not scalable. This is absolutely false. Scalability is not a matter of how to deploy large tickets or how to raise the biggest or the largest fund. The solution for that is in our hand, we, the private equity players. And private equity can be a fantastic tool for that. It's about replicability. Our capacity, there is no small projects. Our capacity to learn, and what Sonia said about education is extremely important to all stakeholders, without any exception. The solution is in replicability. Take small projects that works in a place in the world and see how you can make it replicable across sectors and across geographies. And that's how you end up reaching scalability. Scalability is not let's launch the largest fund to get the largest fees. It's not the way it should be. To meet the obligation or meet the objective of reaching scale, we should focus on replicable, resilient strategies.
So I've got a new acronym for you all after today's session. It's REB, replicability, education, and benchmarkability. And that seems to me to be a big part of the next stages of this whole enterprise. What I've also taken away from this is the sheer energy that emerges, that comes through this whole area of investing. I mean, there is enthusiasm, there is a sense of mission, there is a sense that this is where it's happening, there are new initiatives starting up. So I take away that this is exciting stuff. The challenge is to make sure that we don't get terribly disappointed at the end of it because it doesn't live up to its promise. So that's your job. But I hope that through this session we've helped everybody have helped everybody who has been listening and watching to get some very valuable insights that will give it greater chances of living up to its potential. So I'd like to thank you, Amit, Johnny, and Sonia, for your fantastic insights, your enthusiasm, and really a fascinating session on what is, I think we can firmly conclude from this, a really topical and important subject. Thank you all very much indeed.
Hello, and welcome to this session. My name is Melanie Nerona. I'm a senior editor at the Economist Intelligence Unit, Public Policy and Thought Leadership Division. and I'm pleased to welcome you to this session titled A Snapshot in Time. In today's session, we'll have an in-depth conversation with Abdullah Al-Zamal, Chief Executive at Zamal Industries and the Chairman of the Board at GIB Capital in Saudi Arabia. And today we'll take a closer look at the evolving culture of investing in Saudi Arabia and how impact investing culture can be strengthened. Now, building on the discussions from the previous session, what we've seen during the coronavirus pandemic is that there is an interest in impact investing, and this interest is accelerating. There is evidence that ESG funds are outperforming traditional funds, mainly because of the exclusion of fossil fuel companies in their portfolios, which were among the hardest hit in this pandemic. But to keep this momentum in impact investing going, a lot more needs to be done. And at the heart of this is the investor mindset. Are mainstream investors ready to embrace impact investing? Why do some still remain unconvinced? And what do they need to shift their approach? To discuss this and more, I turn to Abdullah. Welcome, Abdullah. It's a pleasure to have you here with us.
Thank you, Melanie, for having me. Pleasure is mine.
Now, to start off with, let's take a look at the culture of investing. How has the culture of investing changed in Saudi Arabia over the past decade or so? What are the factors that investors are prioritizing today that they weren't 15 years ago?
Well, more specifically, I would say in the past 5 years, since 2015, we've seen a major shift in investment in Saudi, mainly because of the public investment fund being a much more participative investor in the local economy as opposed to PIF prior to 2015. So as we speak today, government have always played a major role in investment in Saudi. But today it's a lot more structured through the public investment fund. It has a medium and long-term plans. It cuts across several sectors in the economy. And it also is introducing totally new sectors that they are hoping to play a role in that eventually could be populated towards the private sector. So yes, in particular, in my opinion, the past 5 years, the public investment fund have played a role in changing the landscape of investment in Saudi.
Okay, that's great to hear. But what about maybe on the private sector side a bit more with the investors, with mainstream investors? Do you see some of their priorities changing as well? Is it still focused on profit? Is it broadening to other factors?
Well, the private sector will always have profit as an integral part of their objective, and shareholder value is always important. But the definition of shareholder value have slightly changed. Environment, social governance, no doubt now is on the agenda of every board meeting, rightfully so. Maybe it was discussed in the past sporadically, but it has never been a structured discussion as it is today. And we have noticed a lot of companies, private, especially the ones that are traded in the stock exchange. You will always find this topic in the board agenda, and to a certain extent, the Saudi Tadawul, which is Saudi Stock Exchange, have issued an ESG guidelines for listed companies. Today, it is recommended guidelines, but I assume that it will probably be mandatory in probably a few months from now.
That's great.
Actually, just to expand on that, the Tadawul Index have worked with the index provider, which is the MSCI, to come up with an index, probably towards the fourth quarter of this year or first quarter of next year. That, in my opinion, will drive that ESG understanding, because already 70 companies in the stock exchange have been earmarked as being potential companies to be part of that ESG index.
And how do you see this being received by companies? Do they see it? Are they receiving it positively, or do you feel that there is some resistance among companies with these guidelines?
Well, keep in mind, government plays a major role in driving private sector, and that is the most of the contracts are either government or semi-government, quasi-government, the likes of Aramco, SABIC, and few others. The government as well as the semi-government have pushed for some kind of an ESG guidelines. So that by itself, in my opinion, will drive the private sector and the publicly listed companies to adhere to those new norms. In addition, a lot of the PIF projects that are being announced are very much environmental driven. Let's take NEOM, for instance. And I served on the founding board of NEOM Industrial City. The issue of environment, zero carbon emission, renewable energy, cutting edge technology being introduced is at the forefront of any new investment that is being targeted for NEOM. So in my opinion, that by itself will truly drive private sector towards that ambitious objective to be able to meet those standards that are being laid out by those government projects.
That's great. And I think ESG guidelines always play an important role in greater adoption. But taking a step back, looking a little bit deeper at the culture within Saudi Arabia and among investors, some research shows that there's a culture of charitable giving in Saudi Arabia, which could underpin the growing interest in impact investing. Do you think impact investing is being seen as an alternative to philanthropy for high net worth individuals, or is there strong interest from mainstream investors as well?
From an Islamic standpoint, there are two areas. One is zakat, which is a mandatory it's a 2.5% of net assets. That is mandatory to be paid by the private sector to charitable organizations, and it has specific guidelines. But there's the other one, which is the charity at large. Yes, Saudi companies and Saudi individuals, especially high net worth individuals, have been very active there. The difference today, I think, is the way it's run. 20 years ago, my dad's generation was just giving out to charitable organizations or individuals, probably erratically. It was never structured in a philanthropy way where it is properly governed within the company, as well as properly governed within the government. Because from a government perspective, also there needs to be a proper watchdog. As you know, we've been plagued with terrorism 20 years ago. And part of the blame at that time was that the charities were not properly watched. I think for the past, I would say, 15 years or so, the government have instituted a very strong governance program to be able to make sure that those funds go to the proper charities and are being spent wisely. Building on that, you see a lot of family companies today in Saudi making sure that the charitable givings is done through a proper governance manual shared among family members, and you'll have a lot of participants, and you'll also see some families that are joining hands to build on that so that they can create scale. So that background, I think, will be a good drive towards smart investing and ESG. It's not there yet, in my opinion, but it will. And keep in mind, a lot of the family offices within family firms are international investors. And today, ESG as a whole have proven to have lower volatility returns. So we've been participating internationally, and I think the spillover effect will no doubt come back to Saudi.
Okay. And I'm glad you mentioned Islamic finance. I wanted to touch on that a little later in the session, but I think this is a good point. I think Islamic finance is a well-established sector in Saudi Arabia. In 2019, the Saudi-based Islamic Development Bank issued a green sukuk that would support renewable energy, green transportation, and so on. And so I'm wondering whether there's an overlap between impact investing and the values of Islamic finance more broadly. So do you see Islamic finance as an instrument to growing impact investing in the kingdom?
Oh, absolutely. I think they're complementary in a big way. Islamic investing is based on no investment in sin products, alcohol, tobacco, gambling, so on and so forth. And environment is one of it. Green sukuk. Remember, the government is a sovereign issuer, and ESG, since I would say about 4 or 5 years ago, when the government decided that ESG is going to be an integral part of its issuance, sukuk was the first to come on board. Sukuk are asset-backed investments mainly, and here there is no room for the multiplicity of derivatives, and it needs to be done against specific assets, and those specific assets can be identified, and they need to be within a certain criteria to meet Islamic norms. By all means, I think Islamic financing is a turbocharge, in my opinion, to impact investment going forward. And I think the government and some multinational entities like IDB and others are driving that.
Absolutely, and that's very exciting to hear you validate that assessment. I think this is an important aspect of it for sure. But I want to just broaden the conversation now a little bit into what more can be done, right? What more can be done to accelerate or to keep this momentum and impact investment going? What do you think is required for this industry to thrive?
Well, if we talk about Saudi specifically, today, the biggest challenge, Saudi is one of the top 10 arid countries in the world. There's a water problem. And almost all of the water in Saudi comes from desalination plants. And frankly, desalination is not very environmental friendly. It has to use a lot of fuel. And Saudi have realized this a long time ago. There has been a lot of research and development on introducing solar as means of operating desal plants. There are two issues. One is the over usage of fossil fuel to run desal plants, but also over usage of water, wastewater. Last year, the Minister of Water came out with a very ambitious program called Qatra, which means droplet, and the idea is to reduce consumption by about 20%, water consumption, that is, through conservation. That by itself, I think, as a government drive, will reduce the consumption of fossil fuel. This is our biggest challenge, is water. It's not cars out in the street. It's really producing drinkable water for the population. So it's a very unique problem in Saudi that needs to be addressed, and that, to answer your question, this is the challenge that needs to be addressed going forward.
Okay, so from what you've said, I gather that I think the government is supporting certain projects that will set an example for what sustainable projects should look like. Do you think that's one issue, that investors need to start seeing case studies, investors need to start seeing more data from mature markets about the success of such impact investments? Do you think some more evidence and examples are what's necessary for investors to become more comfortable?
Yes, the government there was a program called SEEK, the Saudi Energy Efficiency program, which was launched almost 4 or 5 years ago, and we're seeing the benefits today. First time in 45 years, I think, the consumption of electricity in Saudi have actually gone down year on year. It has always been going up, and sometimes double digit. If we compare 2018 to 2019, the consumption has actually gone down. That by itself, in my opinion, is a proof that the government's drive towards using less energy is successful. Government drives a lot of initiatives, and I think the private sector will be a follower. And I think the private sector have always been a very staunch followers to government. So if we take electricity consumption, if we take fuel consumption in desal plants, if we take the new projects that are being introduced like NEOM, Red Sea, those are all very focused on using less fuel. And Saudi in the G20 announced the carbon circle, which is trying to push the utilization of every CO2 output back into a usage of some type. So those, in my opinion, it will take some time, but I think we're heading in the right direction. It's going to be proven to be a bit challenging with the desal, but otherwise, I think the drive is there, and hopefully we will reach some good figures going forward.
That's great. I think another component of assessing opportunities, identifying opportunities for sustainable investing, I think is that companies need to start disclosing information, for instance, on their exposure to climate risk. Do you feel that there's a reluctance from domestic companies to report on ESG metrics in Saudi?
Well, the issue of governance and the transparency of data was not very good in Saudi for many, many years. We've seen in the past few years the government of Saudi issuing a lot of data through the Central Statistics Bureau, which we have not been used to in the past. That has encouraged private companies to follow suit. But also the regulator, in my opinion, has to play a role. Private sector and public listed companies really need to be poked once in a while through proper regulatory environment. And I think the regulator have issued recommendations, they've issued mandatory reporting. I don't think it cuts across all environmental issues, but I can see they're heading towards that way. And I personally fully encourage that.
That's wonderful. It's good to see that that investors are progressive on this front. I think as we come to the end of this interview, what I would like to just get a sense from you is if you can share some final thoughts on what your outlook for impact investing is in Saudi Arabia, the outlook for more ESG-driven investments in the future.
Well, the region have just been recently exposed to ESG and the investment and the impact investment in that regard. I would really like to see sovereign wealth funds, which play a major role in the region. They have, as of late, in my opinion, they've played a major role in playing the role play. They have been the role model for investing. in the region. And in my opinion, they've done a very good job in introducing new and cutting-edge investment models, one of which is ESG. I think some of us will follow suit. My recommendation is for those SWFs to continue that path. And you will find the private sector tagging along and taking advantage of the regulatory environment that surrounds them. Fossil fuel is still an issue, but at the end of the day, for Saudi and the region to be at the forefront of solar energy and wind energy, which Saudi have proven that it is very serious about it. I mean, the whole NEOM project is based on alternative energy. Although oil is very cheap here, but the government have proven that it cares about the environment by launching such projects. And slowly we're finding that alternatives are being more and more competitive, which is good news.
Great. Thank you so much, Abdullah, for your wonderful insights and for your time today. And thank you to the audience, and thank you so much to the audience too for listening in. Please do stay on for our next session, a panel discussion on anchoring the dialogue on impact investing in the region.
Welcome, everyone. We're here to talk about impact investing in the Middle East. And that immediately raises issues, because when impact investors look for opportunities, they often find them in prosperous countries that rate highly on environmental, social, and corporate governance. Emerging economies, by contrast, tend to be a bit dirtier, a bit more corrupt. Oftentimes, their most liquid companies are national champions or ones that work hand in hand with the government and sometimes neglect minority stakeholders. So that complicates the situation in terms of impact investing. But I don't think we want capital only flowing to the most privileged parts of the world. The idea is to encourage developing countries to make progress on human rights, on the environment, on social justice matters. So let's talk about how we can do that in the Middle East. And joining me today are three people who are well qualified for that job. First up is James Zong, who is the Senior Director for Investment and Enterprise at the UN Conference on Trade and Development. Next is Fahad Ahbabi, the Executive Director of the Social Investment Fund Ma'an in the UAE. And lastly, we have Nick O'Donohoe, the Chief Executive of CDC, Britain's Development Finance Institution. James, let's start with you, and let's start broadly before we zero in on the Middle East. We obviously live in weird times. How is impact investing and environmental, social, and corporate governments changing as a result of the times we live in?
Thank you, Roger. I have to start with 2014, on the eve of adoption of Sustainable Development Goals. At that time, UNCTAD was asked to make assessment of the financial needs for SDGs. And we came up with the number, basically, for achieving SDGs, there's a need for kind of financing $5 to $7 trillion, and for developing countries, there is a kind of a gap of $2.5 trillion annually. And based on that, we try to mobilize the resources for investing SDGs. And 6 years since the entering into the SDG implementation, we did a kind of assessment of the progress made with regard to investing SDGs. And we found out that out of the 10 sectors that group the 17 Sustainable Development Goals, 6 out of the 10 had some progress in investing SDGs, meaning the increase significantly in investing SDGs. Having said that, putting them all together, it is far from enough to fill in the gap of the $2.5 trillion annually for developing countries. And that the assessment covers both public and private investment. It covers domestic and foreign investment. So that's the overall investment in SDG situation. Having said that, we do witness a kind of rapid increase of investment in SDGs, the funding for SDGs. According to our estimates, this year, to the UN General Assembly, we see that the sustainability themed investment in SDGs reached 1.3 to 1.5, 1.3 to 1.2 to 1.2 to 1.3 trillion US dollars by the end of last year, and out of that, 900 billion of US dollars of private equity funds that have a sustainability themes, and then also 260 billion US dollars of green bonds, and over 100 billion of US dollars of social bonds. And since the beginning of this year, for the first few months, and COVID-19 related bonds increased to a kind of 55 billion US dollars. So that is kind of equivalent to the social bonds of last year. So there's an increase, and there's sizable impact or sustainability related funds available for investing SDGs. But having said that, we have seen that these funds are basically located in advanced economies, as you said, Roger, that for advanced economies, they are doing well, and these funds are used mainly in the areas related to environment, climate change, energy, renewable energy related sectors. So the funds haven't been really reached to the developing economies, particularly to the least developed countries, and landed in the SDG sectors for poverty alleviation and sustainable development. So that is kind of overall trends in terms of global financing for sustainable development.
Sure. Fahad, maybe I can ask you, I know you work in the UAE, but maybe I can ask you about the region more generally. Why isn't there more impact investing in the Middle East?
Well, from our perspective, Roger, we're trying to bridge a gap between venture philanthropy and impact investment. Impact investment is a very young investment asset class. We believe that having such a vehicle in the United Arab Emirates, specifically in Abu Dhabi, will take us closer to our social development goals. We're working collaboratively with other government agencies to tackle these, I would say, social challenges from an investment perspective, a business lens, where we can address an agile and achieve desired outcome in a very short time. We are adopting this methodology. We want to tackle these challenges and I would say opportunities from an angle that is not only seen from a public servant perspective, as well as encourage the public and private partnerships to develop and address these different social challenges that we have in the region.
And Nick, what role can institutions like CDC play in helping the impact investment industry evolve, especially in places like the Middle East?
Thanks, Roger. So development finance institutions, and CDC is the UK's development finance institution, have played a really, I suppose in many respects, are the original impact investors. CDC was founded in 1948, so we were the first development finance institution in the world. And the founding chairman of CDC, who was a gentleman called Lord Reith, who was also the founder of the BBC, when asked what CDC was for, he said it was for doing good without losing money. And I think that's been pretty consistent theme to our sort of investment history over the last 72 years. And I think where we play a particularly important role, not just CDC, but the broad development finance community, is in the emerging markets. Because as you said, as you pointed out, sometimes easier to find impact investment opportunities in developed markets. And for CDC and all this community of development finance institutions, we are focused exclusively on emerging markets. In our case, exclusively on Africa and South Asia. And I think it's amazing that at a time when there's so much talk, as we heard, about investing behind the SDGs, and there's so much talk about impact investment, you would expect that the continent that has the greatest distance to travel in terms of achieving those SDGs, which is Africa, you'd expect the amount of capital over the last 5 years or so to be increasing. In fact, you'd be wrong, because the amount of capital is actually declining. So there's a real need for organizations like CDC and other impact investors to really address Africa. And I think particularly at this time, particularly post-COVID, when again more capital has been taken out than is been going in. And I think in addition to just providing capital, we have an important responsibility beyond just capital to do things like set standards and metrics, and the DFIs and the organizations like IFC have been instrumental in setting performance standards in environmental and social and governance issues, in setting principles around impact management of portfolios, in helping to harmonize impact metrics. And all of these are critical elements of managing an impact investment portfolio, as well as investing our own capital and mobilizing other people's capital. So the role of the DFIs across the whole impact investment space, but particularly in emerging markets, is a really critical one.
Nick, can I just stick with you for a second? Do you think ethical investors should adopt a sort of economic relativism when they're sort of judging countries? They maybe judge countries relative to their per capita GDP, and in that way you ensure that more money flows to, say, the countries in the Middle East?
Yeah, I think that it'll obviously vary from investor to investor, but if you're a development finance institution, your job is to get money. So I like to say, do the toughest deals in the toughest places. So our job is to get money to the hardest countries and the poorest countries. So in CDC's case, for example, for the last 8 years, we've had what's called a development impact grid, where we score all our investments. And one of the metrics upon which we score the investments is the country. So the tougher the country, the more the sort of the higher the points that we get. And I think it is really important for the impact investment community to, as I say, don't just do the easy stuff, but try to do the difficult things as well, and the riskier things as well.
Fahad, I'm sort of wondering how you use metrics in your job when you're sort of judging where to put money. And I'm especially interested in sort of how we use metrics to measure something like the culture of a company or the culture of an organization, which, it's sort of easy to measure things like environmental impact and even corporate governance. But I think sort of the social bit of the ESG is a difficult part to measure.
I totally agree with you, Roger, and I second Nick and different matrices and standards that are used to drive value for our shareholders. We are to do good without losing money. I think this is the key existence of Ma'an as a social contribution authority, and to be the platform for the Ahbabi community to drive such opportunities and yield the different desired outcomes. Now, we rely on different matrices that rely heavily or partially on social outcome that has been achieved through the different activities we do. More likely, we also drive the economical aspect of it, because it's very important for us that these investments and these opportunities that we support through our institution are sustainable in the short and the long term to drive the desired social outcome from it. So we look basically at two elements when it comes to socio-economic impact at the depth and breadth of the different beneficiaries that we try to tackle, and the different challenges linked to the different impact investment we're doing. As well, we look at the financial, I would say, payout in terms that these investments are sustainable and that they drive value to their beneficiaries and us as an organization.
Mm-hmm. James, you talked about the Sustainable Development Goals, and that's partially sort of a responsibility of governments, but it's also down to the actions of companies. And I'm sort of wondering if you think governments are doing enough to incentivize companies so that these goals can be met by 2030 as they're meant to be?
Yeah, Roger, this is a key issue. In fact, we just did a survey at the beginning of this year for the UN General Assembly to look at the government policies and the strategies in promoting investment into SDGs or into sustainable development areas. And we look at, we surveyed over 100, basically it's 103 countries' investment regulatory framework, including investment promotion strategies. And we hardly see any mentioning of sustainable development goals. And even for sustainable development, investment in this area is kind of not going into specific measures, concrete schemes for promoting investment in sustainable development sector. So that's really a kind of challenging thing. So one challenge is to mainstream sustainable development and SDGs in particular into the current existing investment promotion strategies and regulatory framework. We have also surveyed over 100 countries that have SDG strategies, implementation of SDG strategies. And looking into all these strategies, there are only a few countries that have put in place investment promotion measures into their SDG implementation strategy. So in fact, there's a need for government for this double embedding SDGs into their investment promotion strategies and regulatory framework, and embedding investment promotion strategies into their SDG implementation strategies and plans. So that is one thing. Secondly, the governments are really in a kind of dilemma. The dilemma is that for those sustainable development goal sectors, health, education, public infrastructure, public services infrastructure, and all these agribusiness, these are the areas that are sensitive to government. So for many governments, that they are not open to private sector, not to mention to foreign investment. Of course, there's a reason that these are the sectors critical to the economy, and government needs to make sure that goods and services provided are affordable and accessible by the poor. So there's a dilemma there. Government needs to liberalize these sectors to attract the private investment on the one hand, on the other hand, to ensure that goods and services provided by the private sector are affordable and accessible by the poor. So that serves the purpose of poverty alleviation. Secondly, in those SDG areas in developing countries, in LDCs in particular, the risk-return profile is really not attractive for private sector. So there is a need, on the one hand, for government to put in place a kind of incentive schemes that can attract this type of investment and improve the risk-return profile. And in the meantime, perhaps government also need to target at impact investors. So this is from the government's at the government's level. Regarding the business, I think that there's a need for channeling investment into the sustainable development goal areas, and for that, the first and foremost is to provide guidance to investors, to fund managers, and because of that, we UNCTAD, together with Global Compact, UNEP-FI, and PRI, that we established a kind of UN Sustainable Stock Exchange Initiative, and we started in 2009, and now we have 89 stock exchanges worldwide as members, including the top 20, the largest exchanges in the world, as well as the smallest one in least developed countries. So through that, we try to use the exchanges, which is at the center as a platform for financing, to channel investment into SDG sectors. So the idea is to promote listing firms in this disclosure of sustainable development performance through quality reporting, and then provide sufficient information for good quality benchmarking, and so that to lead investors to invest in SDG sectors. And we're happy that a number of exchanges in the Middle East, in the Gulf region, are members, and they are very active in promoting ESG through the exchange platforms to the listing companies.
Nick, I'm wondering, many countries in the Middle East struggle to attract investment full stop, let alone investment that's sort of focused on improving environmental, social issues, things like that. For countries like that, I'm just, is any investment good investment, or should we always be looking to include sort of ESG considerations in investment decisions? And I sort of have in the back of my mind China, which I'm sure you have experience in regards to Africa. China's increasingly active in the Middle East, and there aren't many ESG strings attached to their investments. And I'm just wondering how worried should we be of that?
So I think it is really important for wherever you're making investments, whether that's in the developed world or in the Middle East, or which is obviously a wealthier part of the world than say sub-Saharan Africa. But I think it is important for investments to be made with certain with standards, and those standards need to be strong environmental and social and governance standards. And that's what, for example, the performance standards, the IFC performance standards that we sort of benchmark against, that's what they impose on our investment process. I think there's an increasing awareness in many countries that Chinese investment may look somewhat more attractive initially, but it's not, but also comes with strings attached. And so, and I think that what we need to do is, and certainly this is our position at CDC, is what we need to do is set the right example, provide capital to the right industries, provide capital through the right sponsors, provide capital that's aligned with government policies in support of the SDGs. And I think that's and not be tempted by perhaps lower standards from capital that may come from other places.
Yeah. Fahad, what are some of the lessons you've taken from your work in the UAE that could also apply to other countries in the region?
Well, we are blessed in the UAE to be among the most generous communities when it comes to the giving index around the world. I think we are ranked among the top 10 in the world, and people are trying now to understand that diversifying their investment portfolio by adding impact investment is a much more lucrative value proposition for these financial institutions. Having the advantage of being a domestic fund in the Emirate of Ahbabi, I think that what really matters today is the pain points of these different communities and how to drive value from addressing these pain points, either by creating different business opportunities around it and activating the community and addressing these social challenges. So I believe that a lesson that can be, I would say, exported to the world is if impact investment really address needs in specific jurisdictions where communities are in need of social development, and the financial product has been structured around it, you will find tremendous capital in place to be diverted to these opportunities, as long as you have, I would say, a clear vision of what are you trying to address with this asset.
Fahad, staying with you, how does Islamic finance fit into all this? Is it a hindrance at all? Is it a positive?
Well, Islamic financing is at the heart of impact investment. I would say Islamic-driven financial products are very structured and aligned with ESG principles and tackle these different opportunities and offers, I would say, different pool of capital accessible to investors to structure these investments through their asset classes.
James, it's tough to talk about sort of ESG in the region without mentioning that the region is one of the biggest producers of fossil fuels. And I'm just wondering how, when we sort of look at the region, we sort of balance that with other considerations when sort of, A, judging it on its progress and B, sort of looking at investors and how they make decisions about where to invest.
Roger, you are right. We all know that this region that produces fossil fuels. I think indeed it is, but in the meantime, the region is also pioneering in green investment and in going for sustainable development. As a number of sovereign wealth funds located in the region are really moving forward in building renewable energy infrastructures that we can see everywhere in UAE, in Saudi Arabia, in a number of countries there. So we see countries on the one hand still rely on the fossil fuel energy for its economy and for export. On the other hand, they do allocate a lot of resources for sustainable development purposes for longer term, like renewable energy and a green economy. So we see that trend is going on, is commendable. I would say, in order to promote further ESG-related investment in the region, there's need a kind of joint efforts by different stakeholders. That is, stock exchanges in the region, the monetary authorities, or we call security regulators, the issuers, policymakers. They need to work together. First and foremost is to improve the standards, the ES standards, to move forward in that respect. And through our collaboration with the region in this capital market promoting ESG issues, we do see some of the governments and the security regulators are doing exceedingly well. For example, the Monetary Authority of Dubai, and it's a member of the IOSCO, the International Organization of Security Commissions, and it chaired the Emerging Market Sustainability Committee, which takes the lead in moving forward ESG issues in the regulatory space. And for that, the role is instrumental. And also itself, the authority itself put in place the guidance in this respect. The same for exchanges in the region. Some of them adopted the ESG guidance that put forward jointly by UNCTAD, us, and the World Federation of Exchanges. So I see that the movement is going on there, and it generates impact. Longer term wise, even at global level, I would see there will be three transformations in the few years, in the coming years. In terms of the business model, ESG will be shifting from icing on the cake to the kind of a mainstreaming as a business model. In terms of standards, at the moment, there's a myriad of standards at different levels, and it's moving towards harmonization of higher level. And in terms of compliance, we see more and more countries and economies now moving from voluntary disclosure and reporting to mandatory. So eventually, we'll see the bar is raising rapidly and at high level, and certainly for the Gulf region, for the Middle East, they will advance in ESG issues and attracting more sustainable investment.
Nick, do you agree with that? That was interesting. The icing on the cake, ESG going from being the icing on the cake to something a lot more mainstream when it comes to investing. I mean, it sort of it risks putting you out of business. But do you agree with what James was saying?
I do. Just before I comment on what James is saying, I also wanted to just comment on Fahad's comments. I was lucky enough to be in January to get asked to speak at the Masic Forum in Riyadh. It was the first time that I'd ever really sort of with an impact investment had been down in the region, and I was firstly enormously impressed because just by the sheer interest in the subject and the number of people, 1,000 or so people at the forum. Secondly, as Fahad said, I think this really strong philanthropic culture that exists in the region. Thirdly, I think the realization that even though, as you said, this is the biggest sort of fossil fuel producing region in the world, a real acceptance of the responsibility and the opportunity also for the region to play an active role in addressing that climate emergency through greener technologies and solar and so on. And then finally, also on Islamic finance, I think we sometimes tend to forget impact investment in the developed countries is a relatively new concept. The term was only invented 10 years ago. And so, if you went back longer than a decade, the idea that you should somehow take note of the impact of your investments alongside the sort of risk and return of your investments was absolutely unknown in the developed world. But in the world of Islamic finance, that sort of value-based investment approach has been around for as long as we can remember. So I think the jump towards impact investment in the region is actually almost easier in some places than it is in the more developed countries because they've sort of been there already are there already with Islamic finance. So I think in answer directly to your question, in a perfect world, all investment would be impact investment, and everybody who was allocating, committing capital anywhere in the world would think not just about risk and return, but would think also about the impact that their investment is having, the externalities that their capital is creating. And I do think that is where we are going. And James has talked about the significant growth in this in sustainable investing. And I think it's going to become just mainstream. And you see it from the most mainstream of the investment management organizations. And you also importantly see it most of all from the clients, from the people who are from the individual savers, from mutual funds, pension funds, a demand for the people running their assets to really think more broadly than just risk and return. That's not the same as giving up return, but thinking more broadly about how their capital is affecting people and planet.
Yeah, Nick, I want to just build on something you said there about sort of what I would call the end of the oil age in the Middle East, and how that is going to be painful, but also sort of provides an opportunity. And I think maybe similarly, you could say something like that about the pandemic that we're currently experiencing. And I'm just wondering what the CDC's view of the Build Back Better agenda is for emerging economies.
Yeah, I think the pandemic is another of those sort of great upheavals in global finance, and those can be sort of galvanizing moments in terms of the way we think about investment. And I think as we consider the critical need to not only obviously respond to COVID itself, but to strengthen financial systems and strengthen sort of health systems, but also rebuild economies. I think that what we're seeing is that the idea of building back better, the idea of having more sustainable, more inclusive, more productive investment approaches is really something that's very much front and center in sort of investors and governments' mindsets.
So we have about 15 minutes left, and I have two more questions that I'd like each of you to take a shot at. Let's start on sort of the more pessimistic note. What's the biggest challenge for impact investors in the Middle East? And I'll start with you, Fahad.
Well, I believe the biggest challenge today in the Middle East when it comes to impact investment is the lack of big ticket items and opportunities that lay within our domestic jurisdiction. We come, I would say, from countries that are very, I would say, invested in their communities, different opportunities that raise all the time, and governments are addressing them through traditional means. However, us as local players and domestic players, we see that there are opportunities around attracting impact investments in investment opportunities that are tech-based, that look after, I would say, the vulnerable groups in our jurisdiction and achieve a long-lasting, sustainable, I would say, impact on the long term. So from our perspective, as Nick mentioned as well earlier, that it is a very nascent, I would say, investment philosophy. From an investment asset class, we are very used to traditional and responsible investments. However, organizations like ourselves are there to bring these innovative investment opportunities to the different, I would say, allocators within our jurisdiction.
James, biggest challenge?
I think the biggest challenge for developing economies is the capacity to prepare pipeline bankable projects for impact investment. And for that, if you look at investment promotion agencies in developing countries, even worldwide, particularly developing countries and least developed countries, there's hardly any capacity in their investment promotion agencies. They are used to the kind of a traditional way of promoting investment into their countries. And basically saying, here's the location, it's just a market at the location, and the targeted investment into specific regions. But for impact investing, and even for investment in SDG sectors, which are low risk return profile, not so attractive, they need to find a way to prepare pipeline bankable projects. And then there's also the issue of large-scale project, because investors cannot go for small ones. Therefore, for small economies, regional collaboration, regional projects, particularly for infrastructure connectivity, is very important. The biggest challenge is to channel investment into the SDG sectors and generate impact on the ground for poverty alleviation. And that we don't see a lot happening yet.
Nick, biggest challenge for the region?
Yeah, look, I broadly agree with what James said. I mean, I think there's a pipeline challenge everywhere of investable projects, particularly where, and in the Middle East or in the region, you are dealing with a lot of quite large, substantial investment funds. They need large projects, and there is a dearth of, there's a lot of what you hear about in the impact investment world is really quite small projects, and they need. I think larger investors need larger scale. The other thing I think is that in common with impact investment everywhere in the world, the challenge for impact investors is to really be able to demonstrate the impact that they're having, because the financial side of the balance sheet's relatively, you could see the results for better or for worse. I think measuring impact and being able to articulate the difference you're making to people's lives, who you're impacting, how you're impacting them, how much you're impacting them, I think that's a challenge everywhere. And without that sort of granularity around the impacts, it's difficult then to grow the impact investment market as a whole.
James, I just want to come back to something you said for a minute. I'm just wondering how big a problem is sort of the regulatory framework in Middle Eastern countries. I used to report from Egypt, where, in order to get a project approved, you'd have to go to 70 different offices. This is the government itself admitting that you had to go to 70 different offices to get approval. How much does that sort of turn potential impact investors off of the region?
This is an excellent question, Roger. In fact, over the years, we have been supporting countries in improving their business climate, improving their regulatory framework and business facilitation facilities. And we do see a kind of progress made, improvement in this respect. But having said that, we're discussing impact investment. At this stage, I don't think countries have special programs targeting at impact investment. Not yet. And that is the interesting thing. Secondly, as I said, SDG sectors are really sensitive sectors. Some countries call it kind of national security issues. So for these sectors, how to attract private investment remains a big question. Infrastructure is the same. Some of the infrastructure are considered as strategic industries or sectors for the country, so they wouldn't like to allow international investment or private sector to be in that respect. So that's what I see. In terms of ESG space at a global level, the interesting phenomenon is that for ESG issues, corporate reporting, disclosure, emerging markets, advanced developing economies are the pioneers for mandatory reporting. While most advanced countries, industrialized countries, they still opt for optional, not mandatory, voluntary. At the most is kind of compliance or report, or explain, compliance or explain. So that is the kind of movement going on. And then there will be kind of least developed countries, small economies, Peru, Kenya, Uganda, Cambodia. For them, the capital market, they have no capacity to implement the ESG issues at all. So this is kind of the three segments of the ESG space that we see. Now, the interesting development is the EU now moving ahead for mandatory reporting for ESG. So that may promote the ESG issues from voluntary to mandatory. That will improve the disclosure reporting, including climate change. And I see the possibility of going to the next step, as I said, transformation at 3 levels.
Let's end on a positive note. Kirichi, give me one main reason to be optimistic about the prospects of ESG in the Middle East and impact investing in the region. And we'll start with you, Fahad.
Well, to be very optimistic, Roger, I think the government in the United Arab Emirates and Abu Dhabi specifically has taken huge leaps when it comes of ease of doing business and putting the right, I would say, regulatory frameworks around public and private partnerships in the region. we are very proud to be one of the most accessible economies around the world. We attract a lot of businesses in many sectors. What we would love to see is more, I would say, opportunities around impact investment when it comes to pipeline and the ticket sizes that we can promote through the different agencies we have in Abu Dhabi. Another note is today the Authority of Social Contribution is acting as a center of excellence for such, I would say, investment principles when it comes to impact investment, social impact bonds, and other innovative opportunities. And for that sole purpose is to promote such, I would say, beneficial investment principles in the region.
Nick, can you give me one reason to be optimistic?
Yeah, I think the reason to be optimistic, and it's similar to what Fahad said, is impact investment starts to take off when you get a combination of asset owners, of investment managers, and of governments coming together to really recognize that there's a need to change the way that they've been thinking about investment, to move away from just this sort of very binary risk and return analysis. And you when you talk to all the talk to asset owners, talk to the large investment managers, talk to government in the Middle East, in the region, you hear that everywhere. And that and some of the steps that they've been taking to think about regulatory changes, to think about disclosures, because I agree with James, that disclosure point is really important. We still live in a world where there's almost nowhere where any company has to disclose any sort of non-financial metric in a sort of a consistent, standardized, audited way. And so you hear about, and so I think there seems to be a real commitment in many places, including in the Middle East, towards that disclosure. So I think there's a lot to feel optimistic about.
Mm-hmm. And James, you get the final word here.
Yeah, thank you. The region generates a lot of funds and huge sovereign wealth funds, but a significant amount of the money is invested outside the region. And the fund's main purpose is for sustainable development for the future generation. Efforts should be made to invest significant amount in the region for sustainable development for future generation. That's my message.
You're confident that
I'm confident
that's going to be?
That will happen because the capacity in the region is increasing significantly. And the leadership in the region, they know what they need, what they want. And this question of putting actions in place to generate investment opportunities, create investment opportunities in its own region, and invest in its own region for its future generation.
Mm. That's a good note to end on, I think. It's a great subject. The Middle East is such a fascinating, complicated, challenging region, and it's certainly that for impact investors. So I'm sure we'll all have plenty more to say about this in the future. Thank you to the panel, James, Fahad, Nick. Thanks so much for joining us, and thank you to everyone else for tuning in here. I'd like to thank you all for participating in our virtual event on investing for impact and mainstreaming socially responsible finance in connection with the G20 Saudi presidency this year. For your information, the footage will be available on demand for the next 12 months, and the link will be distributed to participants via email. Thank you also to our speakers. I've been impressed by the caliber of discussion, and I'm left with a renewed and rather out-of-place sense of optimism given the overall state of the world at the moment. Impact investing is going to play a big role in the future of finance. It's now mainstream thinking that environmental, social, and governance goals are things to be considered alongside profit. A decade ago, this would have been unimaginable. And I'm struck by how uniquely impact investing manifests in the Middle East, courtesy of the region's charitable nature and the role of Islamic finance. But as we've heard today, more such investment is needed, and governments need to do more to enable it. And the pandemic has only made this clearer. Socially responsible finance has a big role to play in achieving Saudi Arabia's agenda for its G20 presidency, and it will be crucial in the efforts by emerging economies to build back better after COVID-19. So I look forward to having the same discussion in 5 years' time and seeing how far the needle has moved. Thanks.